When it comes to building wealth, most people get stuck in a debate: should I save more or invest more? The truth is both are important, but the reality nobody tells you is that you can't effectively invest without a strong foundation of savings. Too often, people rush into investing hoping to get rich quick, only to realize that a single financial emergency can wipe out years of effort. Today, I want to break down why saving is more important than you think, how it complements investment, and the strategies you can use to balance the two so that your money works for you, not the other way around. Wealth doesn't come from luck, it comes from discipline, and that discipline starts with saving. Imagine you're building a house. No matter how amazing your design is, you can't start constructing the walls or the roof without a solid foundation. Your savings are that foundation. Without it, even the most brilliant investment strategy is fragile. Saving is the act of taking control over your finances before you even think about putting money into stocks, real estate, or any other investment vehicle. It's not glamorous, and it doesn't promise instant results, but it provides stability, confidence, and options. When you save consistently, you create a buffer against life's uncertainties, job loss, medical emergencies, car repairs, or unexpected expenses. Without this buffer, investing becomes risky because any sudden need for cash might force you to sell investments at the worst possible time, erasing potential gains. The first step to financial freedom is always ensuring that you have money set aside that can cover 3 to 6 months of living expenses. This is not optional, it's essential. Saving also trains your mind. It develops the habit of delaying gratification, investment, which is one of the most important skills for financial success. Every dollar you save instead of spending reinforces discipline and strengthens your ability to make smarter choices in the future. It teaches you to prioritize long-term benefits over short-term impulses. Once this foundation is strong, you're ready to move into investing. But without savings, you're essentially building on sand. Many people ignore this step because they see investing as the fast track to wealth. They read stories about people turning small amounts into fortunes overnight and assume that saving is unnecessary or slow. The reality is that the story you don't hear is that most of those people had discipline and a financial safety net long before they ever started investing. Saving gives you the freedom to take calculated risks. When you know you have money reserved for emergencies, you can invest without fear. You can ride out market fluctuations, take advantage of opportunities, and make rational decisions rather than emotional ones. It's the safety net that ensures investing doesn't become gambling. Beyond emergencies, savings allow you to capitalize on opportunities that require cash upfront. Real estate deals, business ventures, or even advantageous stock purchases often require liquidity, and that liquidity comes from saving. No matter how smart or educated you are about investing, without money available to put into opportunities when they arise, you're stuck watching from the sidelines. Discipline in saving also builds confidence and peace of mind. Knowing that you have control over your financial life reduces stress and allows you to focus on growth rather than worry about immediate survival. This mental advantage is often underestimated but incredibly powerful. In short, saving is not just a preliminary step to investing, it is the foundation of all financial growth. It provides stability, teaches discipline, protects you from risk, and gives you the flexibility to seize opportunities. Before you think about how to make your money work for you, you need to first make sure you are in control of your money. That control, that security, and that freedom are only possible through disciplined and consistent saving. Once you've built a strong foundation through saving, the next step to growing wealth is understanding the power of compound interest. This concept is often overlooked, but it is one of the most effective forces in wealth creation. Simply put, compound interest is the process where your money earns returns, and those returns themselves start earning returns over time. The longer you leave your money invested, the more exponential the growth becomes. It's not just about how much you invest, it's about how early and consistently you invest. Many people think that investing is only for the wealthy or for those with large sums of money, but the truth is that starting small and starting early can have a massive impact over decades. Even modest amounts, when invested regularly, can snowball into significant wealth because compound interest rewards consistency and patience more than anything else. The key is time and discipline. The earlier you start, the more cycles of growth your money experiences. For example, someone who starts investing $200 a month at age 25 with an average annual return of 8% will likely accumulate far more by retirement than someone who waits until age 35 and invests $500 a month. The math favors early action and steady contributions. Compound interest also works across different types of investments: stocks, bonds, mutual funds, and even certain types of real estate. The principle remains the same: reinvest your earnings, let your investments grow, and resist the temptation to withdraw prematurely. One of the biggest mistakes investors make is treating investing like a short-term game. They expect quick wins and may panic during market volatility, which undermines the magic of compounding. To truly benefit, you need patience and a long-term mindset. It's not about timing the market perfectly, it's about time in the market. Even small incremental contributions over a long period can surpass larger one-time investments made later. Another critical aspect is understanding that compounding doesn't happen in isolation. Your savings fuel your ability to invest, and consistent investments create the conditions for compounding to work its magic. Without disciplined saving, there's no capital to invest, and without investing, there's no compounding. The combination of these two forces, saving and investing, is what separates those who steadily build wealth from those who struggle financially. Compound interest doesn't reward the impatient, the sporadic, or the reckless. It rewards consistency, foresight, and the willingness to plan for the future. By committing to regular investment contributions, reinvesting earnings, and staying the course even during periods of uncertainty, you give your money the opportunity to grow exponentially. Over time, this growth can become substantial enough to fund retirement, create financial freedom, or provide opportunities that would be impossible with saving alone. Understanding and leveraging compound interest is not just a strategy, it's a mindset. It teaches discipline, patience, and long-term thinking, which are invaluable traits in wealth building. When combined with a strong habit of saving, it becomes the engine that powers financial growth, turning small, consistent actions today into substantial outcomes decades down the road. While saving and investing are critical for wealth creation, one of the most overlooked aspects of financial success is risk management. Life is unpredictable. Jobs can be lost, businesses can fail, markets can crash, and unexpected expenses can appear without warning. Without a financial safety net, even the best laid investment plans can collapse under pressure. This is why saving is not just about accumulation. It's about protection. A well-stocked savings account acts as a buffer against uncertainty, allowing you to navigate life's surprises without derailing your long-term financial goals. Emergency funds give you options. When you face sudden expenses, you don't have to liquidate investments at an inopportune time, which could result in losses or missed growth. Instead, you have cash readily available to cover immediate needs. This creates a sense of security that allows you to make rational decisions instead of reacting out of fear or desperation. Risk management through savings also provides flexibility when it comes to investing. Investing inherently involves some level of uncertainty. Markets fluctuate and no investment is completely guaranteed. However, when you have sufficient savings to cover emergencies and short-term obligations, you can invest with confidence, knowing that temporary downturns won't force you to sell at a loss. This confidence allows you to hold investments long enough for them to grow, taking full advantage of compounding and long-term returns. Beyond financial emergencies, having cash reserves allows you to seize opportunities. Great investments often require liquidity upfront. Without savings, you might miss out on high return opportunities simply because you didn't have the funds to act quickly. Risk management isn't just about avoiding losses, it's also about positioning yourself to capitalize on gains. Another critical component of managing risk is mental stability. Financial stress can cloud judgment, lead to impulsive decisions, and even impact physical and emotional health. Knowing that you have a financial cushion provides peace of mind, allowing you to focus on growth rather than constantly worrying about survival. Saving also protects against the unpredictable nature of human life. Health emergencies, family responsibilities, or sudden obligations can arise at any moment. Without savings, these events can push you into debt or force you to compromise your long-term goals. The most financially successful individuals often attribute their stability not only to smart investments, but also to the safety nets they built through disciplined saving. It is this combination, preparedness and opportunity, that allows them to navigate challenges while continuing to grow wealth. Effective risk management is about more than just reacting to emergencies. It's about creating the freedom to make intentional, strategic financial decisions. By consistently saving, you reduce vulnerability, increase resilience, and provide yourself with the flexibility to invest wisely. This dual approach, saving to protect and investing to grow, ensures that you are prepared for the uncertainties of life while still actively building wealth. In the end, managing risk through saving is not a passive act. It is an essential strategy that underpins every successful investment decision, ensuring stability, peace of mind, and the ability to capitalize on opportunities when they arise. Finding the right balance between saving and investing is where true financial mastery begins. Many people treat these two actions as separate, almost competing goals, but in reality, they are complementary. Saving provides the foundation and security, while investing allows your money to grow and compound over time. Understanding when to prioritize one over the other is key to building sustainable wealth. Early in your financial journey, the emphasis should be on saving. This is the stage where you are creating stability, building an emergency fund, and developing the habit of living below your means. Without this safety net, investing can become unnecessarily risky because any financial shock could force you to liquidate investments prematurely, cutting your growth potential. By focusing on savings first, you establish a strong platform from which you can confidently take calculated risks in the investment world. Once you have a sufficient cushion, your focus can gradually shift toward investing. The goal here is to make your money work for you over the long term, taking advantage of compounding and market growth. However, this doesn't mean abandoning savings entirely. Even as you invest, maintaining a portion of your income in liquid savings is crucial for flexibility and risk management. The balance is dynamic and depends on personal circumstances. Someone with a stable job, minimal debt, and low immediate expenses might allocate more toward investments, while someone with unpredictable income or family responsibilities might prioritize savings for longer. The key is regular evaluation and adjustment. Another important factor in balancing saving and investing is mindset. Saving is often seen as restrictive or boring, while investing feels exciting and aspirational. The truth is that both require discipline, foresight, and patience. You need to respect the role of saving in creating freedom, the freedom to invest without fear, and the freedom to handle life's uncertainties. At the same time, you need to respect the role of investing in creating growth, the ability to turn money into wealth over time rather than letting it sit idle and lose value to inflation. Practical strategies can help maintain this balance. Setting clear goals, such as short-term emergency funds, mid-term purchases, and long-term retirement targets, allows you to allocate funds intelligently between saving and investing. Automating contributions to both accounts ensures consistency and reduces the temptation to overspend. It's also important to consider risk tolerance. Higher risk investments might promise higher returns, but they should only be pursued if your savings provide a reliable buffer. This creates a financial ecosystem where growth and protection coexist, each enhancing the other. Ultimately, financial success is not about choosing between saving and investing. It's about integrating them in a way that fits your life and your goals. Saving without investing may provide safety but limits growth, while investing without saving exposes you to unnecessary risk. By understanding the roles of each, prioritizing appropriately, and adjusting based on your personal situation, you can achieve both security and wealth. The balance between saving and investing is not a one-time decision. It's a continuous practice of evaluating your needs, opportunities, and long-term objectives, ensuring that every dollar serves a purpose in building a secure, prosperous future.